Hello again, everyone. I am Raj Malhotra, ITPM Senior Trading Mentor. So if you've been following me for the last few months, you know I'm been one of the very few on a very small island championing that there was a good chance we're going to get a very hated rally to around 6,000 in the S&P by late summer. So as we're sitting here around 6350 in the S&P, it shouldn't have surprised anyone that we had this aggressive rally if you look back at history. Now, if you look at the rally off the April 9th lows, over the next month, you saw close to a 20% rally. Now, that's only happened 5 times in history where the S&P's rallied that much that fast. And if you look at each one of those times, on average, the S&P's rallied another 30% over the next year. So what that means is if history is going to repeat itself now, that means we should get to over 7,100 by next May. And the market looks well on its way, at least for now, to do so. Now, while that's impressive on the top line, what I'm looking for is I'm looking below the surface to see if the market can broaden out, because I think that's where there's the real opportunity. I strongly believe that if we're going to get above 7,000, you need to see this broadening out occur. And what I think is, I don't think it can be just in the large tech names which have dominated gains. Yes, I think they should probably rally if we get that to that level. But I think what we need a broad-based rally here with other sectors participating, as well as small caps and mid caps. Because I really believe that's where the outperformance will come from going forward. Now, the best way to gauge the strength of a market from the broad perspective, in my opinion, is to look at the RSP ETF, which is the equal-weighted S&P 500 index. So look at the chart here. On last Friday, the RSP reached an all-time high before pulling back earlier this week. There's not much to read into that, in my opinion, since the RSP was overbought. We just had a Fed decision where Powell stubbornly not wanting to signal he was going to raise rates, probably despite Trump. However, forget all that. If the RSP continues to go higher in overbought conditions, I think this rally could really get legs. An RSP rally would signal better overall health for the whole economy rather than just for Silicon Valley. And it will also signal that the breadth of the market is strong. And if that happens, that's really good for us fundamental traders, as I believe underloved sectors and stocks that are now perceived as value could actually see their value unlocked. And this will probably lead to new market leadership. The RSP's previous high was at the end of November, about a few weeks after Trump was elected. So see here, the cap-weighted S&P is up about 5.5% since then, and the RSP is down a little over 1%. So it's been about a 7% divergence. Looking forward, any businesses that could benefit from tax and deregulation from the big beautiful bill, or even stocks that finally have some tariff conclusion, which eliminate uncertainty, could absolutely be a beneficiary going forward. So my advice is look for sectors that could fit that bill. I think consumer discretionary and apparel are a candidate. I believe that they could come back strong, basically just because tariff fears have mostly subsided. Remember, the market hates uncertainty more than the market hates bad news. So a baseline 15% tariff is fine as long as there is certainty around that event. And I believe that's where we are, or at least close to getting there, despite all the noise. I think apparel and footwear in particular has potential legs, and the market's starting to realize if you look at some of the other names, not the one I'm going to highlight. For example, VF Corp, which makes brands such as Timberland, North Face, Vans, they just reported earnings and rallied over 10% on earnings. JP Morgan just upgraded Nike, which was a dog for a long time, and they raised their price target from $63 all the way to $94. I mean, if you think about it, people aren't going to stop buying shoes just because prices went a little bit up across the board. However, the name I want to highlight here is an under-the-radar name in footwear apparel, and I think the one it's worth looking at, Deckers Outdoor, ticker DECK. Now, Deckers, the cup has a portfolio of brands that include Uggs, Tevas, and most notably HOKA. The company generates over $5 billion in annual revenue, and it's up about 3x since 2019. The market, though, trades at a $16 billion market cap and has around a 16 PE, which gives it room for multiple expansion. Now, one thing to note, Deckers, they acquired both Uggs and HOKA when they were just startups, and the company itself has proven to be a very savvy brand manager. They scaled up these brands through marketing, manufacturing, and distribution, and they've achieved industry leading gross margins, which are approaching 60%, which is very impressive in this sector of the market. However, looking back at this year, the stock has struggled a lot this year, and it was mostly around concerns about slowing growth, and obviously because of tariffs. And even after their most previous earnings report on July 24th, which the stock had a nice bump, the stock is still down 44% year to date. I think this presents an excellent buying opportunity, especially as tariffs are in the rearview mirror, as the market hopefully starts to broaden out, and a value company this could finally see its value unlocked. Those are all potential tailwinds, but let's not just look at the macro picture. Let's look at the fundamentals here. While they have previously had growth rates of over 20%, those are numbers that are just virtually impossible for consumer brands to sustain forever. But having said all that, while their revenue growth for Q4 was 6.5%, they blew that away in their recent report. So some of the fears should have subsided from the death of HOKA might have been greatly exaggerated. The company reported earnings of 93 cents versus expectations of 68 cents. The revenues grew about 17% on a year-over-year basis. And HOKA in particular saw a re-acceleration revenue jumping 20%. And going into that report, there was big concern around that brand. And hopefully they've now subsided. Now, the ones that were worried about HOKA's growth, if you look at what the HOKA brand itself, they had $2.2 billion of revenue, which might sound like a lot, but amongst sneaker sales, that's only around 1% of the total addressable market. And remember, this is a brand this is a company that's learned how to improve their brands through marketing distribution, like I said earlier. So I think a 2 to 3% market share is easily attainable just on creating brand awareness and what they've done in the past. And if you use the law of small numbers, think about going from 1% of the total addressable market to 2 to 3% would do for the company's revenues and hence their stock price if they actually increase market share. Now, what they didn't do was they did not raise their next quarter guidance, but I suspect that's by design because I think there's no reason to do so. I think they want to lower expectations and then beat them. If you look at their growth, it was mostly in international markets and in the wholesale segment, and that should be the driver going forward, considering how little of their sales are actually there. Look at their international sales alone. The international sales grew 50%, and I believe there's a lot more to come there. So Deckers is also trading at a discount to the S&P, but I don't believe it should given its impressive growth, the fact that it has no debt, and has $1.7 billion in cash, which is about more than 10% of their market cap. Now, this company has been and is continuing to buy back shares, and I think that could add another potential tailwind. With that $1.7 billion, they could buy another company. They could make a strategic acquisition and find the next HOKA or the next winner. But I hope they don't do that because that could cause short-term downward pressure. But it's a company that was in the wrong sector. But when you look below the hood, I believe it's gotten too unfairly punished. I think those confluence of factors that I've touched on could rally the stock 50% or more, or even approach its year-to-date high of over $200. So in terms of trade structure, let's look at a calendar spread to give us more time to be right in more ways. So look here, if you had $5,000 to spend, what I would do is I would buy 7 of the October 110 calls and sell 4 of the September 120 calls. You could pay $8.30 for the Octobers and sell the Septembers for $2.55 and spend around $4,800. Now, if the stock went up too fast, too quickly, let's say it went to 140 in September, you would make around $15,500 on the Octobers, but you would lose around $7,000 on the Septembers. But you would still make a profit of $8,560 or about a 1.79 to 1 risk reward, which would still be pretty good considering you had 2 months and you had bad timing and you'd still make close to 200%. let's say the stock stayed below 120 before September expiration, and then rallied 40% all the way up to 155. You collected the full credit in September, so you made that $1,020. Those October calls that you were long would be worth $45 minus what you paid for them. You make $25,690 just on that leg of the trade. So combined, you make around $26,710 divided by your initial spend. It's a 5.58 to 1 risk reward. Obviously, a great trade. And let's say you really hit a home run in this trade, and the stock went to $200 by October. So those October calls will be worth $90 minus what you paid. You make a little over $57,000 on that October leg, plus a little over $1,000 you collect on the September. You make over $58,000 on that on the combined trade, divided by your initial spend. You make over a 12 to 1 risk reward. Now that would be a real kick in the you know what. So with that, I'm watching for a broad market rally and find sectors and in the small cap, mid cap space that could be undervalued, that could really rocket higher if this market broadens out. With that, I'm Raj Malhotra, ITPM Senior Trading Mentor. Happy trading. I'll see you guys on the other side.